Good morning, everybody. Welcome to our spring budget analysis from the statement yesterday. A bit earlier than usual because I'm actually going on a conference in Dublin, flying at 1:15 today. So we're doing the webinar now, and then I'm heading straight to the airport. So hopefully that's all right for everybody. Just a bit of housekeeping before we start. So if you can't hear me via your computer audio at the minute, see on screen the login details for via telephone number and access code accordingly. As always, I mean, we should be well used to this by now, but if there's any technology issues, I apologize in advance. For those that don't know me, I'm one of the tax directors at Mitchell Charlesworth. I particularly specialize in corporate tax matters, particular restructurings, reorganizations, mergers, acquisitions, R&D tax relief tend to be my areas of expertise. But also as Mitchell Charlesworth have an array of talented individuals who specialize in various different fields, covering all tax effectively. Please don't hesitate to ask any questions during the webinar via the chat function. I'll then try and answer as many of these as I possibly can at the end of the webinar, or alternatively, you can always contact me directly after the webinar. Email address is up on screen, and it'll be up on the end of the session as well. Session's being recorded, so it'll be circulated along with the slides following this webinar. So what we're going to talk about today, because yesterday's announcement was a little bit of a damp squib in terms of we kind of knew everything that was going to be announced before the announcement. There was no rabbit out of the hat in that respect. So I'm just going to recap on some previous announcements and where we are currently now. Income tax changes, so in particular how the national insurance reductions are going to impact your net income moving forward. I'm going to spend a bit of time on what everyone's talking about, stealth tax, and what is that? What does that actually mean, and how is that actually impacting us as we head further and further into this cycle of frozen thresholds and allowances? I'm going to touch on property tax. There's a few in particular changes announced around property, how properties are going to be taxed, and gains are going to be taxed, and sales are going to be taxed, and purchases are going to be taxed, and how that impacts us as well. We covered this last time because this was a bit of an announcement from last time, but the R&D tax relief is changing, and we've got this simplified merge scheme coming into play. So again, just a recap on that, because that effectively comes into place from the 1st of April 2024. Not massive amounts announced on corporation tax, but an overview of the key ones that were announced and how that could impact certain businesses. And then just an overview of some of the other announcements announced and any questions that anybody has. So what do we know that was coming into place from April 2024? So income tax thresholds, I was just mentioning about the stealth tax section, which we'll cover in a bit more detail shortly. But they're remaining frozen and will be frozen until April 2028. So personal allowance remain frozen at 12,570, basic rate band 50,270, the additional rate band 125,140. Dividend allowance is reducing. So for the current tax year, it's £1,000. That's reducing to £500, and that's where it will be maintained for now, effectively, until somebody decides to change their minds. Annual exemption for capital gains tax is also reducing, so currently £6,000 down to £3,000. Again, that will be maintained at that level. Corporation tax rates unaffected at the moment, so we'll have a maximum rate of 25% even, for profits over 250,000, and 19% for profits under 50,000, and a marginal rate in between the 50,000 and 250,000. We'll discuss this in a lot more detail shortly, but merger R&D scheme implemented for accounting periods beginning after the 1st of April, and restrictions on overseas expenditure coming from the 1st of April 2024 as well. So, income tax and national insurance changes, in particular national insurance changes, really. Obviously, we've had many changes to thresholds and rates over the last 24 months. Additional rate band is staying at 125,140. So you're paying 45% as soon as your personal allowance has been lost. Basic rate of income tax remain at 20%. No reduction. So there's a lot of talk pre-budget that this is going to be reduced. Obviously, Rishi Sunak, when he was Chancellor in 2022, said that the income tax rate would reduce by 2024. that target hasn't been met. But at the moment, we are staying at 20%. And it looks like, based off what Jeremy Hunt was saying in the speech, that that isn't going to change for the foreseeable future. They are going to continue to target national insurance. Dividend tax rates, they have remained the same, no changes there. So 8.75% for a basic rate taxpayer, 33.75% for a high rate taxpayer, and 39.35% for an additional rate taxpayer. As we just mentioned before, dividend allowance is reducing, so down from £1,000 to £500. And here's where the big changes come into play. So in the autumn statement, they reduced Class 1 national insurance to 10% from the 6th of April 2024. And then in this statement, they announced a further 2% reduction, so reducing the Class 1 national insurance rate to 8%. Key to note, no changes to Class 1A national insurance, and so no changes to your employer's national insurance liability. That is still remaining at 13.8%. But overall, a 4% reduction in the headline rate since the 6th of January 2024. Class 4 national insurance, which is for the self-employed individuals, that's reduced from 9% to 6% from April 2024. It was supposed to reduce to 8% initially, but a further 2% has been knocked off that as well. And as was announced in the autumn statement last time, Class 2 NI is no longer compulsory. And as I've mentioned as well before, personal allowance, income tax thresholds, and national insurance thresholds will remain the same until April 2028 as it stands. So what does a national insurance cut mean in real terms? So in the previous statement, obviously we had the 2% cut, and I showed the differential between what it was pre-cut and what it was post-cut. And this slide's slightly the same in that without the cut, if for 2024-25, based on a level of income, you would have received a set net figure from a salary. So, for example, 50,000 would have got you £38,771 net income in your hand after income tax and national insurance. It's a further reduction there for now with the additional 2% knocked off and being down to an 8% rate. So, actually, for a higher rate taxpayer, you've received going to receive an additional £754 of net income in your hands as a result of the cut in national insurance. The £450 that is widely discussed in the press, that's based on an average salary of £35,000 per annum. So that's where that 450 comes. But the maximum benefit you can get from the NI cut is £754 in that cut in isolation. But when you factor it in with the cut we received on the 6th of January, and compare that to the start of 2023-24. So start of 23-24, the rate for national insurance was 12%. And again, if I just pick on the £50,000 line there, £50,000 at the start of 23-24 would have got you a net income of £38,022. For 24-25, that's increased to £39,520. So nearly £1,500 better off from this national insurance cut. Always helpful for employees, always helpful for individuals to receive that a little bit extra cash in their hands, effectively about £125 extra per month in net terms. For dividends, and this slide we covered previously, there's a slight reduction in dividend income, and that's just because of the reduction in the dividend allowance. So no matter what threshold of income we're talking about here, £43 less as a result of the £500 reduction in dividend allowance, and that's because more is being taxed at that 8.75% rate. I think this slide is becoming more and more important because of the reduction and continued reduction in Class 1 national insurance. When is the best time to switch? Should we be on a salary? Should we be on a dividend? So this comparison is based on the same cost of the company being incurred. So we calculate what's the cost of a salary. So what's the cost of a 50 grand, 75 grand salary, for example, and using that same cost of the company, what salary dividend can we have and what's that net income? And that gap is vastly reducing now. Looking at a 30 grand salary, there's not a lot of difference in this at all anymore. And it's as it gets higher, the difference gets much lower as well. So the only anomaly in all that is this £125,000 bit. And that's purely because under this salary and dividend model, you do have a lower gross income because of the way that we calculate it. So you're not losing as much as your personal allowance. But in the other examples, the difference is getting smaller and smaller. And if they continue to cut national insurance, that difference will get even smaller and smaller to the point where we might be having discussions about, actually, is it more beneficial just to be on salary rather than salary and dividend? Quite an interesting point there, something we will keep an eye on as any more changes happen in the future, depending on which government we have in the future as well. But what's been talked about most isn't really an announcement from the budget or announcement made to try and correct this position, but everybody's talking in tax world and the press about stealth tax. And what do we actually mean by stealth tax? It affects every taxpayer going, and it relates purely to the frozen personal allowance and income tax thresholds, national insurance thresholds as well, whilst wages rise with inflation. So as wages are continuing to rise, it means more and more people are being dragged into tax or into higher rates of tax, more than should have been effectively, because if the allowances and the thresholds also rose with inflation, it would have kept these people out of those higher bands accordingly. So effectively, as the allowances and thresholds are not being increased in line with inflation, this means that in real terms, more tax is being paid on income than it would have been. And what I'm going to show you over on the next slides is an example of how this could potentially work. Just how is it working and how does that affect my tax position ultimately? So what I'm going to assume for this example is that over the period April 2021 to April 2028, so that's the period that the bands have been frozen or planning to be frozen for, I'm going to assume an inflation of 30% over that period of time. And what the first slide is going to show you is what is the effective tax rate if the band's raised with inflation, and what is then the bands being frozen. What is the effective rate of tax with the bands being frozen? I've not factored in national insurance into this example. It was just a little bit too complicated for me to pull that together yesterday. So I'm just purely focused on the income tax rates. So this is the first example. So in 2021, 2022, we've got our gross salaries on the left-hand side there. And that's what in 21, 22, you'd have a tax liability as based on the rates and thresholds at that point in time, which are still the same. So if I pick on the 50 grand line again, being picked on today, but if I just pick on that one, 50 grand gross salary in 21, 22 would have triggered an income tax liability of £7,486. So effective income tax rate on that is 14.97%, being the 7,486 divided by the £50,000. So let's keep that 14.97 in mind as we move forward. So in the next slide, this shows, okay, well, if the bands continue to move and the income is moving with inflation, what would the tax liability be and what would the effective tax rate be as well? And you can see that the 50 grand, that's increased to £65,000, being a 30% uplift in inflation, provides a tax liability, a higher tax liability because we're earning more money, of £9,732. But the effective tax rate, if we just go back, has remained the same on that line in particular, 14.97%. There is a slight difference in the 100 grand line because, as I've put at the bottom there, I've not taken into account that the 100 grand allowance for when you start losing your personal allowance moves with inflation, because that never has moved with inflation. That's always been a relatively fixed number ever since that rate came into place. So I've calculated that slightly differently. That's why there's a higher effective tax rate in that line compared to the previous slide. But if we could just pick on the third line down still for now, we've still got an effective tax rate of 14.97%. That's how normally the tax system would have worked. But back in 21-22, it was announced that the bands would be frozen. No increases in the bands until initially it was going to be 25-26, and then it got extended to 27-28. And how does that impact our position? So again, the income has increased by 30%, but the bands have stayed the same. So we've still got the 12,570, the 50,270, the 100 grand threshold for personal allowance, the 125, 140 for for additional rate taxpayers as well. And as you can see, if I just pick on the third line down again, effective tax rate has jumped to 20.66%. We're paying £13,432 in income tax, and on the previous side, we were only paying £9,732 in income tax. So a jump of nearly £4,000 in tax liability. And that's where the talk is about this hidden tax, this stealth tax. The government is obtaining more income because the bands haven't moved. Obviously, inflation has been much higher than probably forecast and planned at that point as well. But the tax take is increasing because income is increasing, but the bands aren't increasing with it. And I felt that was an important point to try and show you all, because it's something that affects us all. You know, it affects us as employees, it affects directors, shareholders on salary dividends, it affects pension holders, because if their pensions are rising, the bands aren't going with it as well. It affects everybody, and is something that has been called to be changed and still hasn't been changed. And I can't see it changing under the current government, because as I said earlier, they're really focusing on national insurance. I saw a LinkedIn post by Rishi Sunak this morning trying to explain how it's unfair because you've been taxed double as an employee. I mean, we've had national insurance around for many, many years, so it's somehow only just being deemed unfair, but that's each to their own. But they're focusing more on that than this underlying issue, which impacts everybody effectively, and it impacts the lowest earners as well as the highest earners. So property tax changes. So there wasn't enough headroom for Jeremy Hunt in this budget to just give the national insurance reduction and not do much else, you know, not try and raise taxes in other ways. We saw that with a couple of other reforms to vaping, for example, that were being brought in, and non-dom status as well being scrapped. So he's had to raise some money to fund this big ticket headline cut in national insurance. And one area he's focusing on is two property tax reliefs in particular. The first of this is furnished holiday lettings relief. So this provided some beneficial tax treatment to individuals that were renting out effectively holiday homes and furnished lettings. So for example, nowadays, your Airbnb type scenario, you're letting out a fully furnished rental, and you could therefore be treated as a trader for tax purposes as opposed to an investor. And that allowed you to claim business asset disposal of BADR. You could claim capital allowances on the furnishings that you were purchasing, and the earnings counted for pension purposes as well. So it counted into determining adjusted net income for making pension contributions and obtaining tax relief on pension contributions. All that is being scrapped from April 2025. There will no longer be a furnished holiday lettings relief available. So we've got it for the rest of this tax year. We've got it for next tax year. April 2025, it's gone. The actual tax treatment of that income, apart from the capital allowances bit, is the same. You will be subject to income tax on the profit that's been made on those lettings. You just won't be able to claim the capital allowances treatment. You'll pay more in capital gains tax in the future. So because you could claim business asset disposal relief, you were able to pay 10%. Now you'll be treated as if you're selling a property rather than selling a trading asset. And for pension purposes, that might impact certain people's ability to put more into their pension pots tax efficiently. The second announcement was the abolishment of multiple dwellings relief. So this is a stamp duty land tax relief where individuals buying more than one property in one transaction can effectively spread the value of the property. So instead of, if I bought one property for 100 grand, one for 200 grand, and determining what's the stamp duty on the 100 grand purchase and what's the stamp duty on the 200 grand purchase, it would average out to say 150 grand for each property, and we calculate stamp duty land tax on that basis. This is commonly used in a couple of scenarios in particular. So for example, if there's a property investor who's buying 6 flats in the same block, they would look to be claiming multiple dwellings relief. Or where we see it more often with planning purposes is where we've got a sole property portfolio owner who's looking to incorporate their portfolio and that helps to minimize the stamp duty land tax on that incoming incoming to the property into the property company. I say sole property portfolio owner because if you're in a partnership, you're still exempt from SDLT, provided you meet certain criteria. So this is purely for your sole property portfolio owner. The result of that being scrapped will increase stamp duty land tax on that planning piece and incorporation piece. So it, again, may mean actually it's not worthwhile, and having a look at that in terms of what's the upfront cost from a stamp duty land tax point of view compared to what's the tax saving going to receive by having it within a limited company. That can be looked at, that can be discussed in more detail, but that's quite a significant relief that's been removed from the 1st of June 2024. On the positive, we're talking about in the second bullet point down about finished holiday lettings. Okay, you won't be able to pay tax at 10% on the sale of that property in the future, but gains incurred on the sale of residential properties, aside from your main residence, which will continue to qualify for principal private residence relief, they will now be taxed at 24% from the 6th of April 2024 rather than 28%. So a 4% reduction in the headline rate for gains on sale of residential properties. So particularly relevant again for disposal of second homes or portfolio properties, and you're paying a slightly less capital gains tax on that disposal. R&D tax relief changes. Again, people that tuned in previously to this one will be aware of what we've been talking about previously and some of the changes and some of how HMRC are acting and performing. So this is a bit of a recap of the position and where we stand. So last 12 months has been a bit of a minefield in terms of R&D claims. HMRC have started to clamp down, and I've always said, rightly so, you know, there's a lot of claims that go in that shouldn't be going in, and HMRC should be clamping down on this relief. Their approach to that has been haphazard, in my view. You know, they are raising inquiries into completely legitimate claims and sticking to a certain point, and that's not helpful for R&D type businesses as a whole. But there's been a significant increase in the number of inquiries, perceived incorrect and or forgery claims being made. In the autumn statement 2023, for county periods beginning on or after the 1st of April 2024, there will be a merged R&D scheme that is based on the current RDEC scheme. So they're changing it from having a RDEC scheme for large companies, and what we mean by a large company is turnover over 100 million euros, net assets over 86 million euros, and more than 500 employees, and 2 of those 3 having to be hit, to a scheme and the SME scheme, which we have for anybody below that, to one scheme to cover everybody. In theory, to simplify the relief, and that's coming in for accounting periods beginning on or after the 1st of April 2024. So effectively, in a normal 12-month period, the first period that's going to be affected by that is the year ending the 31st of March 2025. It won't affect any periods before then if it's a standard 12-month period. There's been a lot of calls for this to be delayed. It's been rushed out a little bit. Certain things haven't been thought through from a perspective of the CIOT, so Chartered Institute of Taxation, ICAW for Institute of Chartered Accountants for England and Wales, all saying, look, this hasn't been thought through massively. It's not really been discussed a lot with, had a consultation, for example, maybe you should delay this. No such announcement was made in the budget, so this looks like it's pressing ahead. And it's going to be a little bit of a mix of some of the elements we have within SME scheme and some of the elements we have in the RDEC scheme. So, for example, the new scheme in RDEC world, you can't claim for contracted out R&D. So if you, for example, develop an IT solution and you have third parties working on that IT solution, on developing that IT solution, under the SME scheme, you can claim for that cost. Under the RDEC scheme, you can't, whereas the new merge scheme will allow you to claim for that. And the SME pay-as-you-earn and an NI cap is going to be used rather than the RDEC cap. So RDEC cap's a bit more stringent. This is your figure. If your credit is above that figure, then you can't have that yet. You have to carry it forward. Whereas the SME pay-as-you-earn and NI cap is 3 times your pay-as-you-earn and NI plus another 20,000 on top. So that's a bit more beneficial than the current RDEC rate. So the notional RDEC rate offered is going to be 20%, which is in line with the current RDEC scheme. This is what we class as an above the line credit. So effectively, it would, in your P&L, it would almost sit as other income, and it will be subject to corporation tax therefore as well. So if you're a profit-making entity, you'll pay provide a net benefit of 15%, so the 20% credit times by 25%. And if you're a loss-making SME, it's 16.2%, because what has been agreed is that if you're loss-making, the credit will only be subject to tax at 19%. So that provides a higher net benefit under that scenario for loss-making SMEs. We also have the restriction on overseas expenditure that's going to come in from the 1st of April 2024. So effectively what we're talking about there is that the costs and the R&D need to be taking place in the UK from the 1st of April 2024. So if you're utilising overseas individuals to develop and support you on an R&D project, in very limited circumstances, they will be allowable. In the vast majority, they won't be allowable moving forward. So you may well need to have a rethink as to how you undertake your R&D, who's undertaking your R&D, to allow for that position to be maximised in the future. So just to give you an example of the merge scheme, if we use an example of £100,000 of qualifying expenditure being incurred, this credit will be subject to 20% credit, providing an initial credit of £20,000 in the computation. And the credit is above the line, and for profit-making companies, this will be subject to corporation tax of 25%. Therefore, the net benefit will be 15 grand. For loss-making SME, the credit will be taxed at 19% and will provide a net benefit of 16,200. If you're a profit-making SME, that 15 grand will ultimately come off your corporation tax liability. If you're a loss-making SME, that will be paid out as cash, that's £16,200. And the balance will, for the loss-making SMEs, will be carried forward as well. So, where's the difference? So what's the difference between the SME scheme and the MERS scheme? And we can see here that actually it's a big reduction potentially for SME scheme people at the moment compared to the MERS scheme. So, for example, 100 grand worth of R&D expenditure under the current SME scheme, that provides an additional benefit of £21,500. That's been calculated that for every £1 you get an extra 86p in the pound in tax relief. That at 25% corporation tax rate gives you £21,500. Under the MERS scheme, you'll get 15,000. So it's a reduction in relief of 6,500. A substantial decrease and something that needs to be factored in when planning your R&D claims and what match you can get back from that R&D claim moving forward as well. There is, in a merge scheme that was meant to bring everybody together, there is then also a second scheme. You tell me how that makes sense, but we have something called the R&D Intensive Companies Scheme. And this, again, announced in previous budgets, and it's being maintained within the new merge scheme for SMEs that are classed as R&D intensive companies, and they will be able to claim under the existing SME rules effectively, rather than having to claim under the new merge scheme. So for an SME to be classed as an R&D intensive company, it needs to be loss making, and from the for accounting period starting after the 1st of April 2024, there needs to be having a total expenditure needs to be of their total R&D expenditure needs to be 30% of their total expenditure in that accounting period. For periods beginning before the 1st of April 2023, it's 40% threshold. So that threshold has been slightly reduced. So effectively, if I've got total expenditure of 200 grand in my R&D intensive company, at least £60,000 is going to have to be identified as R&D spend in different categories. If it's below that, you fall into the merge scheme. If you that or above, you can fall into the R&D intensive scheme. And what this allows that company to do in particular is utilise the SME cash credit regime. So this provides a headline cash credit rate of 14.5% of the losses that are surrendered. And that effectively provides a maximum relief of 26.97p for every £1 that's spent being available for the cash credit. So just as an example, again, let's use £100,000 worth of expenditure under the R&D intensive scheme. This cost would be enhanced by 86%, as I was discussing before, and gives us a total R&D cost for tax purposes of £186,000. That loss can be surrendered, and it's the lower of the corporation tax loss or the total R&D expenditure. And I'm just going to assume for this purpose that the lower figure is the R&D expenditure. So surrendering that 186,000 for the cash credit at 14.5% provides a credit of 26,970. 26,970 divided by the 100 grand, that gives us our 26.97p for every £1 that's spent on R&D. So just then, last few bits and moving on to a few minor announcements that were made, just to cover them off. As I said earlier on, corporation tax was quite light on announcements in this budget. Not much that was being driven towards businesses. There was a couple though, just to pick up on. In the previous budgets, we've had the full expensing announcements. So in the autumn statement, we had full expensing coming in, being made permanent. So it's not going to be ending anytime soon. What full expensing does provides 100% relief on the purchase of new and unused plant and machinery with no upper threshold. So annual investment allowance has an upper threshold of £1 million spread between connected companies, whereas full expensing, no threshold, every company can claim it, and provides certainty on what tax relief you're going to get on potentially some big acquisitions of plant and machinery. They're going to extend, at the minute, full expensing is not available if you're buying the assets to then lease out, but that definition is going to be extended over time. No timetable as to when that's going to occur. We're expecting the draft legislation to be released in the next few weeks, and once we have that, we'll be able to provide a bit more of an update on that matter. One of the other announcements was in relation to theatres, orchestras, and then museum and galleries tax relief. So in October 2021, to assist these types of businesses or charities in particular, at that point, as many are set up in that way, to assist these types of businesses post-COVID, the rates that you could claim for this tax relief were substantially higher, more than doubled in some instances. What was meant to happen from March 2025 is that these rates were meant to reduce back down to their pre-COVID rates. So again, a significant cut potentially there. What's been announced is that new rates will come into place from the 1st of April 2025, ranging between 40 and 45% cash credit rates for these types of businesses. So substantially higher than what they were meant to reduce down to, but a slight reduction on where they currently are. So for example, orchestra tax relief at the minute is a 50% rate that they benefit from. That's going to reduce down to a 45% rate. So slight reduction, still better than what it would have been, but a slight reduction on where we are currently. And then there was a new tax relief announced for independent films. So we have the film tax credit scheme, been renamed recently to the audiovisual expenditure credit scheme, but effectively film tax relief, whereby you've got big movies being made in the UK can benefit from a credit being received during the production of those films. They've now brought one in for effectively your small independent films, budget below £15 million, again, UK films as well. And then just some of the other announcements that were made in the budget and some of the information we've had post that. So child benefit reforms. So very punitive set of rules at the minute is child benefit, in that if you are a single parent and you earn over 50 grand and then between 50 and 60 grand, you start to lose your child benefit. Whereas if you have a two-parent household, both earning £49,000 each, you can still claim full child benefit. So a lot of talk has been had about that. If anybody watches Martin Lewis, he's had many things to say about this previously. What they've announced is over the next couple of years, child benefit is going to be reformed, and it's going to be based on a household system as opposed to individual systems, which sounds like it makes fair sense. Obviously, the devil will be in the detail and how that will actually come into place. But in the meantime, what they've done is actually, this is the one threshold they've decided to increase. So actually, from April 2024, the higher income benefit charge will only kick in once you start earning over 60,000, and it will be tapered between 60,000 and 80,000. So effectively, if you earn over £80,000, you shouldn't be claiming child benefits. You just got to pay back. If you earn between 60 and 80,000, depending on personal circumstances, but you might want to claim it to then have to pay some of it back. But if you've got a 2-parent household, both earning under £60,000 each, then you can claim your child benefit in full. VAT registration thresholds increased as well. That's increased from £85,000 to £90,000 from the 1st of April 2024. A lot of talk, obviously, because this is the Labour idea, and there's a lot of back and forth on this in the speeches in the speech and post-speech. The non-dom status has been abolished from April 2025. It's going to be replaced with a new system based on residency. I haven't gone into major detail on it here. They reckon it's going to save them about between 2.5 and £3 billion. Once we know more about it, I'll explain a bit more for those that it's important to. Alcohol duty, that's going to be frozen until February 2025. It's a 6-month extension. And the fuel duty is frozen, but then the temporary 5p cut that was meant to end on the 31st of March 2024 has been extended to the 31st of March 2025. So in summary, as I said earlier, it's budget without a rabbit in the bag, rabbit out the bag item, with the major items already being known and announced pre-budget. Further cutting national insurance is welcome for individuals, and it appears that's where they're going to head. As I say, I saw a video this morning, Rishi Sunak, who's made it quite clear that actually they want to get rid of national insurance in the long term. So they're going to focus more down that route than looking to cut income tax in the future. It was all being talked about. This is like the pre-election budget. So this is going to be the one where the Conservatives set out their stall and then we go to the polls. There wasn't any major giveaways there that suggested actually they're going to be ready to go to the polls anytime soon. It would suggest that potentially we're going to get another awesome statement under this government, then followed by an election. So the awesome statement potentially going to set out the big ticket items, what they want to do, and then we have the election in late 2024. That would be my guess. That would be what I think is potentially going to happen here. I hope everybody enjoyed it. If there's any questions, I'll just check on the chat function